Hey everyone, and welcome to today's episode of Pivot to Profit. I'm your host, Pam Jordan, founder of Pivot Business Group, and our amazing co-host today is Alexis Sidney. What's up?
What's going on?
All right, y'all, we're going to talk about depreciation today. It's so much fun. No, it's not. It's super confusing and it's monopoly money, but we'll get into that here in a minute. But before we start, look, if you're a founder, business owner, and you are wondering where your money's going, you're not sure why you got this big tax bill, you have no idea what the future holds for your business, and there's just not enough money in the bank, we would love to help you. Just go to pamjordan.com, book a call with our team. We would love to walk you through our process, help you understand your numbers so that you can feel confident sleeping at night, that your money is going to the right places and that you are building your wealth. All right, Alexis, dun dun, depreciation. I call this monopoly money because it is kind of real money, kind of not real money. Give us a simple definition, explanation as to what depreciation is in plain English.
All right, so let's make it real plain. So depreciation is when you buy an asset, equipment, a car, property, or just something that you purchase for your business. Over time, those things loses its value. So what depreciation is it allows you to get a write-off for whatever you purchase, depending on its useful life, and say, hey, we're going to let you take a bit of this on your taxes each year. So even if it's like a loan on a vehicle, you didn't fully pay for the car upfront, like cash in hand, you can still say, hey, this car is a $50,000 car, and I can get this write-off of the car year after year after year. So that's the simple way to explain depreciation for tax purposes.
I love it. So what I hear you saying is depreciation is how you write off a big purchase like equipment, a vehicle, furniture over time instead of all at once.
Yeah. Well, you can still, now there's another caveat we didn't get into yet, where there is bonus depreciation.
Okay.
Where you can write it off at once if it makes sense to do that and is advantageous for you. So instead of saying, hey, this car is going to take me, useful life, I think it's 5-7 years to write it off. Instead of it taking that long, you can say, hey, I really need these deductions this year because I got a huge tax liability. So I'm going to go ahead and take advantage of bonus depreciation or accelerated depreciation and write it off that tax year. And it's like, wow, save me thousands of dollars. So it just really depends on the strategy as opposed to take it straight line, useful life, or bonus depreciation or
Okay.
accelerate.
So there's different kinds. We'll get into that in a second. But why should business owners care about depreciation? Why should this be something that they're paying attention to?
Well, you definitely want to pay attention to it because you're spending the money, so you want to get those deductions. And as, the law is, like if we purchase assets for the business, they're not dollar for dollar expenses. So you want to make sure that those things that you're purchasing, that you're taking the depreciation so that you can get the write-offs for them time over time, because you cannot put them on your profit and loss report to say, hey, I brought a car for $50,000. I'm going to get a $50,000 deduction. It doesn't work that way. So that's why it's key that you are taking things into depreciation or considering depreciation. So that way you have a plan of action. So you'll know like, hey, I'm getting this much depreciation in addition to whatever else I'm writing off during the tax year. So those things help you with more savings. It's almost like you said, monopoly savings.
Exactly. And I think you had a really good call out there, Alexis, is a lot of business owners think that all money that they spend and all the things they purchase for their business just go on their profit and loss and is just a write-off. And unfortunately, that's not the case when it comes to these larger purchases. Typically, vehicles, furniture, large assets, equipment, any of that, even buildings, anything of large value like that sits on your balance sheet in the asset section. And so depreciation is how we are legally allowed to write off a portion of those assets and pull part of that value onto the profit and loss. So that's a huge call out. It's just because you buy a $30,000 truck doesn't mean it shows up as a $30,000 expense on your P&L. It shows up as a $30,000 asset on your balance sheet that a portion of that we can then put on the P&L. So just really entrepreneurs, founders understand that not everything you buy goes straight to the P&L. I have seen trucks, I've seen RVs, I've seen all kinds of things. Oh, well, I bought it for the business. Well, your Rover might be a business expense, but we cannot put that on the P&L for $90,000. And so just understand that these larger purchases that are necessary and ordinary for your business don't live on your P&L. And the IRS amount to capitalize an asset is $2,500. Is that correct, Alexis?
Yes.
So that means your Apple laptop that's $3,000 is not a straight business expense. It is now an asset because you bought the $3,000 one, not the $2,000.
Yeah, that's the rule of thumb that we go by. Is like, anything under that, just go ahead and expense. But anything over that number, make sure it's an asset and that you're tracking it. You put it on your books. You get you a depreciation report that you can manage outside of the tax return, because that's a whole nother conversation if it's not on the books the right way. So just make sure that, you're definitely tracking those assets and knowing like, hey, when is this expiring? How much more depreciation do I have year after year? Because that's key in tax strategy, is knowing what's in the back pocket to be able to help you with more savings.
Awesome. Awesome. I love it. So there are different kinds of depreciation. Just to make it more complicated, there's straight line, there's double declining, there's accelerated, there's 179, there's bonus. There's so many different types of depreciation. Pretend we're 10-year-olds. Try to help us understand the different types and why we would use each different one.
Yeah, so let's just the pretty straightforward is straight line depreciation. Easy breezy math. The IRS has a useful life chart where they say, hey, equipment, paper, I'm just making up stuff right now, falls into this 5-year category. So you get 5 years to write anything off in this asset class. So you would take the value of what you purchased that, asset for and just divide it by 5. And each year you get that amount of depreciation. And after that, it's gone. No more. So that's
basic math of straight line depreciation. I buy a $10,000 something for my business. The IRS code says its useful life is 5 years. 10,000 divided by 5 years is 2,000 a year. I get $2,000 of depreciation a year for 5 years. Super straightforward, super basic, the easiest one to understand. Check A+. Good job. Let's make it more complicated.
Yeah, so then, as Pam mentioned before, there's double declining balance. That's more of an accelerated method for larger deductions when you want to take it earlier. So again, what you can do for that, just think like, hey, bonus depreciation. I'm going to be able to, depending on what the asset is, what the law has going on, we can say, hey, I spent 100,000 on this asset. And because I'm going to accelerate the depreciation, I get to take up to this amount this year and carry the balance over the useful life of it. So talking about that now, there's a lot of talk on the streets, the tax streets, is that, hey, 100% bonus depreciation is coming back. So as we know, during COVID, it was a lovely period where 100% bonus depreciation was available. And then each year after that, it went 20 to 80%, 60, and now I think we're at 60% going to 40. But with the administration, they're talking about, hey, going back to 100%. So everybody's just on standby for this 100% because that's saying, hey, if I went and brought houses or assets at these large amounts, that I can take 100% bonus depreciation in this tax year. That is so huge for people with huge tax liabilities, or they're needing some write-offs and they're needing to find a way to maximize their tax strategy plans and savings. That's key there. So that's what that depreciation method is, just kind of easy breezy trying to explain it.
I know it's complicated. So let's talk about section 179.
Yeah.
This is a nice one.
Yeah, so 179 allows you to take an asset, same concept as bonus depreciation, but the math is just a little different because, again, the 100% bonus was phased out, but it's coming back. And so 179 has been around, it's been on
Long
the, it's not going anywhere. I don't think it's going anywhere. So the difference is with 179, it allows you to take a huge, substantial portion of whatever that asset is that you purchased upfront and that tax year. And then the remaining part of it, you get to, write off over the phase of the life of the product until it phases out. So that's just the easiest way to explain it. So instead of you getting 100% or 80 or 60, based on the math of the asset. And then I think it caps at a certain dollar amount for that year.
Yep.
So you get that portion of it, and then anything else carries over to the future tax year. So if there was no bonus, 179 is what we'll use to accelerate the depreciation for you.
And the cap changes every year, but it's like $1 million. So it's a lot of money. So if you're a very equipment and vehicle asset heavy company and you go out and have to go buy a $500,000 piece of equipment, you can definitely use Section 179 to write it all off in year one. But be prepared. That's great for taxes. But if you finance that thing, which is a whole other side of this, right? Like if you get a loan for $500,000 and you're making payments for the next 6 years, but you write it all off in year one, you have no depreciation to offset those payments.
Right. And then keep in mind, I know you mentioned the amount is large, which is true. It is a large amount, but it does vary for the asset. So with vehicles, the 600-pound and over vehicle,
6,000 pound.
did
There you
I
go.
say 600? Sorry.
You're good. 6,000, 3 tons, right?
Yeah, so just keep in mind, like they have a max number on that. So it's not just up to 1 million. So we do need to be specific on what type of asset falls into 179 so that you fully understand, like, what you're playing with when it comes to depreciation and what you can carry over, and just have a solid plan in place.
And that's the thing where depreciation is something you can't ignore because the IRS doesn't ignore it and your tax preparer doesn't ignore it. So you as a business owner need to understand what assets you have and what type of depreciation you have available to you, which is why it's good to have a proactive tax approach to say with your tax strategist, "Hey Alexis, I want to go purchase this vehicle. What's the best way to do it? Do I purchase it? Do I lease it? Does the business buy it? Do I buy it?" And that's where having those conversations where a tax strategist like Alexis can tell you, here's the tax advantages of each one of those. Here's what we recommend based on your current business situation. Because there's times where leasing a piece of equipment is better for you than purchasing it. And then doing a 179 is better than doing straight line. And it just depends on the year. Because like Alexis said, if you have a very profitable year, then some of the bonus depreciation and all these things are strategies that you're going to want to take advantage of.
Definitely. Definitely you want to. So you don't want to miss depreciation. And, it's key that you don't miss it because the IRS doesn't care if you missed it. That's a whole nother topic. So you definitely want to make sure that you're taking depreciation because if and when you go to dispose of assets, there's this thing called recapture that we'll talk about. But when you go to recapture, the IRS is looking like, hey, you had this asset. And even if you didn't take the depreciation, they're going to calculate it as if you did because you were supposed to. And that causes problems or can open up a can of worms for you taxpayers. So just put that in your memory bank and just make sure that that's on the table as well.
I love it. So, what are some other common pitfalls that you see business owners making when it comes to depreciation? I've got a couple, but let's start with your list.
Well, definitely. I see like a lot of business owners aren't really knowledgeable on what is an asset versus an expense, and definitely not tracking the assets. I love to see the stuff in the books. It makes life easier. But when you have business owners that have like tons of assets, like, over 50, you definitely just want to make sure that you have a tracking system in place and that you're definitely updating it yearly as you're preparing for your taxes or whatnot, just so you can make sure that, hey, I know my assets, I know how much depreciation I've taken, I know what type of depreciation I've taken with these assets. This is my book of depreciation assets, and just really knowing like this is how you need to manage, depreciation of your assets. So that's the number one thing that I see with business owners. How about you?
The biggest thing that I see, and I had two conversations with some founders just in the past weeks. Depreciation isn't real money. And so a lot of business owners see depreciation on their P&L and they relate that to dollars leaving their bank account, and it's not. And had to explain that that is a representation of the write-off of the asset over time, not actual, and it does not actually affect your bank balance. And that's a really hard concept because it's on the P&L. And the other thing that I see business owners not understanding is depreciation, because it's not actual money leaving your bank, affects your valuation because it's an add back. So you want to make sure that this is being tracked properly, because if someone's ever going to do a valuation of your business and you don't have a clear depreciation schedule or depreciation line item in your P&L to add back, it's going to actually hurt your valuation. So number one, it's not actual real money. That's why I call it monopoly money, because it's not leaving your bank account. It can represent money leaving your bank account, but it's not actually leaving your bank account. And by not tracking it accurately, you can have a lower valuation of your business.
Yeah, definitely. That's key. And like I mentioned, earlier or just a few words ago about the recapture part, that's another pitfall as well, because business owners have no clue. It's like, yeah, I'm getting all this depreciation, I'm doing all this stuff, and it's great. Life is good. And then it's like when you go to sell that asset or dispose of it and you don't have a plan, there's depreciation recapture. Now, there are strategies and things that we can do when you're working with the proper tax strategist that can help offset any depreciation recapture, or just add strategies into your tax strategy plan to help offset any possible recapture. That's a whole nother conversation. So there are things you can do, but I think just the common understanding is that you do have to recapture depreciation if you don't have a plan of action on your tax return.
Alexis, can you give us a simple example of recapture? Like someone buys a truck and then they write it off with a Section 179, a bonus or whatever, and then they sell it 2 years later. How does depreciation recapture come into that? Or if you've got a better example, give us a tangible example so that we can understand.
Yeah, let's use a house. How about that?
I
This
love
is
it.
real funny. So I was working with a client a few years back and they had a rental property. So of course, whenever you put the house into service and it becomes a rental, you can now start taking depreciation on that rental property. And that helps because, it's key. Rentals, a lot of depreciation. It helps lower your rental income, all that stuff. So what happened was, for one, the person they were working with prior to me did not put the rental into service the right way, didn't have depreciation. So we had to go back and fix that part because, like I said, when you go to dispose of the asset, the IRS is saying, hey, it was put into service. This is the amount of depreciation recapture we're looking at. And the client is like, I didn't take it. That's not their fault. So that was an example. So what happened was the client sold the house at the same price that they purchased it for. And I was like, well, that's fine. Because in their head, it was like, we didn't make a gain from the sale of the property. And I was like, well, how do you buy and sell a property at the same price? Like, I didn't get that part, but they thought they were avoiding capital gains. I was like, nice try, but there's depreciation recapture where this property has been in service for 10 years and you've taken on average, let's just say $3,000 in depreciation each year. So that's a significant amount of money that the IRS is saying, hey, we have to recapture this and add it back so that we can get, our tax is paid on this in addition to any capital gains that you may have to pay. So that can add a significant amount of money back to your tax bill because it's like we gave it to you up front to help you offset. But now that you dispose of it, we need to recapture the depreciation that we gave you to help offset during the years. But with it, had the client decided, hey, because it's a rental property, that I'm going to go and do a 1031 exchange or get a similar property, they would have avoided
All of
the
that.
recapture all of the capital gains because they got a like asset in a certain time frame, and they put strategy to their situation to not have to pay any tax liability on the situation. So that was an easy breezy, I hope, story to
No,
help.
that makes sense. And I think what it comes down to is, you guys, when you buy an asset, depreciation is a way that the IRS is, quote, helping you write it off over time as an expense. But if you sell that asset, the IRS is going to want their piece of the pie. Like, they're still going to want to be paid if there's a gain on that. So it's important to understand, if you're looking to sell an asset, to have a conversation with your tax strategist to know what are the tax ramifications of it, because it might not make sense to sell that asset right now because of the tax ramifications of it. Like, capital gains are one thing, but depreciation recapture is a whole nother number that you might not be calculating when you're looking at selling an asset.
Right, definitely. So you just really want to have a solid plan in place and not try to create your own tax strategy. They tried it trying to avoid capital gains, which was fine. But, recapture is a thing as well. So, and there's ways to fix it. Like if you say, hey, I have not been taking depreciation and I should have, what do I do? Like you can get with your tax professional, and there are some forms that can be completed to go ahead and make that adjustment for you. You don't want to have the attitude like, oh, well, I'll just let it be, because as we can see, when you go to sell, the recapture is going to be there regardless. So,
All right. So, Alexis, give us a closing suggestion, word of advice, something for business owners to take forth and succeed with.
yeah, so definitely my parting words will be to get you an asset tracker for depreciation. It makes life just a little bit more easy and more manageable. I know a lot of times we're like, I can't put this stuff on the books. I don't do this, or you may not be working with a bookkeeping team. And that's even more of the reason why you should have a tracker with your assets, so that for one, you know what you have in your business as an asset, but definitely so that you can know, hey, how much depreciation do I have to take advantage of? And definitely take advantage of the depreciation, because again, if you don't, you're still going to have recapture when you sell your assets. How about that? Mhm.
I love it. I love it. And my parting words here is, depreciation is not something that you need to ignore. It is something that the IRS is not ignoring on your behalf. So make sure that if you have assets, you have intelligent conversations with someone. They can explain to you how this is affecting your business, because it is a non-cash strategy to reduce your taxes, but it is affecting your numbers. And you need to understand how this depreciation monopoly money is affecting your numbers, because it's not directly affecting your bank account. So just be aware of how this is affecting your business based on the assets that you have, because it is affecting your financial reports. All right, awesome. I know that that was a lot, y'all. Hopefully, if anything, it has raised some flags for you that, oh, maybe this is something that you need to dig further into. We are here to support you. Make sure that you like and subscribe to the podcast, Apple Podcast, YouTube, Spotify, wherever you're listening. We are here to support you at pamjordan.com. We'd love to talk to you as tax strategists about how to handle the confusing world of it depends when it comes to taxes. And just remember, you guys, that it's not what you make that matters, it's what you keep. Well, time. Thanks, everyone.